Is the VIX broken? What does the spike in equity volatility mean for major equity indexes like the S&P 500 and the Nasdaq? What's the historical framework for what this means when the VIX reaches the extreme levels that we've witnessed in the last week? Hey, I'm Dave Keller with Market Misbehavior. Today we're going to talk about the spike in volatility, how that relates to other signs of market fear and market uncertainty, and what that may imply for the major equity benchmarks in the month of August. Before we get to a lot of great charts and insights, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions, and when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. So here's the chart of the VIX, and I'm actually going back quite some time, going back to the great financial crisis here of 2009, just to give us a historical reference point to where we're at. Now, I usually look just at the closing values of the VIX because there's a lot of noise intraday on things, but I did want to show the intraday data just to illustrate how high the VIX actually reached at the beginning of this week. On Monday, the VIX actually pushed briefly above the 65 level, and it's only reached that level twice in the last 20 years. The last time was during the COVID low when the VIX actually briefly went above 80. And then the previous time was at the late 2008 before the 2009 market low when the VIX spiked above 80 as well. So, the VIX above 65 is the third highest reading that we've had in the last 20 years, which, again, I guess could be worse. But, relative to those historical norms, very, very low. And obviously a lot more significant than the lows that we experienced or the brief pullbacks we experienced in 2018 and 2015, 2011, and 2010. Now, what's interesting is if you think of those 4 points, 2018, 2015, 2011, and 2010, those are basically the 4 major most buyable lows that we experienced from 2009 to 2020, right? During that period, you had a number of sort of brief pullbacks. Now, brief, I mean within the context of a long-term market sense, but in the short term, these were 3-month pullbacks on average, with some significant drawdown along the way. So what this means potentially is we have a similar pullback to the scenarios that we saw in 2018, 15, 11, and 10. I think it's one of the great benefits of looking at an indicator like the VIX is you can immediately look to the left and just see where we're at right now relative to where we've been. Now, what's interesting is after we spiked up to above 65, we actually settled back and the VIX ended just below 40. And if you look, as we're looking at this on Tuesday, right after the U.S. market opened, the VIX is sort of in the low 30s. Now, I have some horizontal lines drawn here to illustrate some key levels that I've found to be pretty meaningful. 15, any VIX below 15 tells me conditions are pretty calm. The market is in a slow and steady uptrend, most likely. This is sort of a classic bull market configuration. As you can see from much of like 2013, 14, 16, 17, these nice kind of long uptrend years, the VIX for the most part remained below that 15 level. Between 15 and 20 is a warning. We actually had a couple warnings over the last 12 months. In late 23 going into the October low, sort of between August and October. And then in mid 2024 going into the April low, the VIX spent some time between 15 and 20. That's sort of your pullback range, telling you that fear is a little bit elevated, but not extreme. VIX between 20 and like 29 tells you conditions are getting much more significant. This is more sort of the correction range. And if you look back at the major pullback phases that we've experienced since the 2009 market low, pretty much every one of those has seen a VIX spend a lot of time between 20 and 30. Above 30 and extreme reading above 40 really tells us we're in a correction, full-blown correction in line with previous major drawdowns like the COVID low and the financial crisis in 2008 to 2009. Now, what's interesting, and I was talking with Bruce Marshall of Simpler Trading at the Money Show last week. Really enjoyed have time to talk with Bruce, and we talked about the VIX. And the discussion that we had was basically the topic of this video: is the VIX broken? And it's hard to really tell, but I would say talking with Bruce really clarified how much the options market has changed in the last couple of years. The growth in zero DTE options, the change in liquidity, the incredible liquidity in those short-term options has really changed the dynamic, I would argue, of a lot of option-related indicators like the VIX, like put-call ratios that are all based on positioning in options that are a little further out than that. So the fact that so many options traders are playing that very, very short-term time frame, I think is probably skewing the data. So maybe that spike in the VIX that we experienced over the last week is just sort of an unusual reading, and the VIX now is different than it was in 2020 and 2009. That's why I would argue that it's great to be able to use something like the VIX with other indicators that arguably have not changed as much. And I'll show you two others that I find very important that maybe collaborate what we've seen or corroborate the high readings that we've seen in the VIX. Because a spike in the VIX basically means elevated uncertainty, elevated fear, and elevated risk of market downside. So how does that relate to two other indicators I could show you? Now we're looking at high yield option adjusted spreads. And sorry if that's a word salad you're not familiar with, but an option adjusted spread basically means a bond spread, and option adjusted means it just adjusts for call options or some sort of structural nuance in different bonds. A spread is basically a credit spread. So how expensive this bond is relative to a risk-free bond, like a treasury bond. Bonds don't trade in terms of price terms. Usually they're not quoted. They're usually quoted in terms of a spread, the spread above a risk-free rate, like a treasury bond. So an option adjusted spread is basically just how much this bond is trading for. And high yield index option adjusted spread means we're just looking at high risk companies or high yield companies or junk bond issuers. So companies that are a little less proven, a little less stable, a little lower quality, and their credit ratings are so low, they're termed junk bonds or high yield bonds. And we can track the performance of high yield bonds using a ticker like HYG or JNK. Those are both ETFs that track the high yield bond space. Here's the reality. I am plotting the high yield index option adjusted spread. As you may notice from the y-axis, I'm plotting it upside down. I'll explain why in a minute. The VIX is next, and that's plotted upside down just so you can show how closely the correlation is, or how closely these two series act very, very similar. Because when investors are getting nervous in terms of, as measured by volatility and the VIX, they're probably, bond investors are probably getting nervous as well, and that's reflected in spreads widening out. Finally, at the bottom, we have the S&P 500. That is plotted in its normal scale because when high yield spreads widen and volatility increases, that usually means stock prices are going down. You can see that in the last couple weeks. Most recently, or before this recent data, you can see it in March and April of this year when high yield spreads widen, meaning bond investors are getting a little more nervous. Volatility increases, meaning index option investors are getting a little more uncertain. And you can see that the S&P, of course, went down in early April. Before that, you can see in August through October of 2023, widening spreads, spike in volatility, downtrend in stock. So this sort of pattern of widening spreads lines up very well with periods where we've seen elevated volatility, and that tends to be when stock prices are going down. So what's happening right now looks very similar to drawdowns that we've experienced just over the last 12 months, but going back further, you'll find a lot of very similar patterns and agreement between those levels. Final chart I will tell you that sort of corroborates what we're seeing with the spike in volatility is the performance in defensive sectors. Now, I did a video on this just a couple weeks ago. I'll put a link in the description if you want to check it out. but we talked about one of the items on my bull market top checklist is an improvement in defensive sectors. One of the reasons why that's so helpful, I guess the reason why that's so helpful, is because there are a lot of money managers that have to be fully invested. So it's not just they buy growth stocks and then they go to cash, and then they buy value stocks and then they go to cash. Part of their mandate is basically that they have to be fully invested, meaning they have to own equities of some sort at any point. So what do you do if you have to own equities and you're concerned that the markets are going to go down? You go defensive. You go big, higher yield, higher income, lower volatility sectors like utilities and consumer staples and real estate. And as we talked about in that previous video, a spike in the performance of those sectors usually indicates that money managers are trying to get defensive and ride out periods of market uncertainty. Since we did that video, that is exactly what we have seen. Here I'm showing the relative performance of the utility sector going higher, relative performance of the consumer staples sector going higher, relative performance of the real estate sector going higher. As I mentioned in that video, and as I'll mention again today, that checklist identifying some of the key characteristics of market tops and what we're seeing now versus that historical playbook, that is the sort of thing that I like to talk about with my Market Misbehavior Premium members. Check it out if you're looking for help navigating these uncertain times and uncharted waters, as it were. Go to marketmisbehavior.com/premium or use the links that you see on the screen. And I'd love to have you consider that. Use the code YouTube when you check out for a special discount on our regular rates. So the rebound, or I guess the reemergence of the performance of these defensive sectors, utilities, consumer staples, and real estate, I would argue sort of lines up with widening credit spreads, which means bond investors are seeing conditions get less ideal, and then the spike in volatility, which implies that the index options market is indicating excess fear and excess volatility. All of those things together tell me to be bracing for a higher and higher likelihood of further deterioration in risk assets, most likely going to a major low in September and October, as we've seen pretty much most years going back for the last 5 to 10 years. What do you think about this market environment and the dramatic change that we've observed in some of these risky chart signals? Let me know in the comment below what you see as next for the S&P and the Nasdaq and why. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.